Alistair, Wall Street was also disappointed with the latest GDP figures. It showed a 3% growth over the second quarter. My question is, how can you have a growth rate of 3% and a disappointing jobs data? And I can only think of one thing. Maybe all these jobs are coming from McDonald's, but I want your point of view.
I think the answer to this lies in the stocking of imported goods ahead of Trump's tariffs. Now, the way GDP is calculated is that you need to take away imports because they are not produced domestically and add in exports, which are sent abroad. So when you have a trade deficit on goods and services such that you are a net importer, then the net import figure has to be taken away from GDP. When you do that, then obviously you reduce GDP for a country like America, and for a country like China, that adds to GDP. All the stocking that's occurred earlier in this year by importers trying to beat the rush, if you like, ahead of tariffs, has made a major contribution to the unadjusted GDP numbers. So that, I think, basically is what has been going on. And when analysts see that in one quarter it has increased by 3%, or an annual rate of 3%, and the previous quarter it had increased by zero or whatever, they will look at these changes, if you like, in stock levels from imported goods, very much in that context. So the 3% increase, I think, is something that reflects that increase in stocks of imported goods. So this is why, we look at the economy, we see 3% growth annualized in one quarter, when we know that the economy is actually not doing at all well, when we also begin to have confirmation that non-farm payroll numbers are disappointing. And furthermore, they're being adjusted downwards for previous months. So that, I think, is how you tie the two things together.